Welcome to the Apartment Guys, where we dive deep into all things multifamily investing. Our mission is to educate, inspire, and empower real estate investors to reach their highest potential. Each week, host Tate Siemer interviews high-level guests from all over the industry who are sure to bring valuable, actionable ideas that will propel your career to the next level. Whether you're just starting out or a seasoned investor, you are in the right place. And now your host, the Apartment Guy, Tate Siemer.
Welcome everybody back. Another episode of the Apartment Guys. And I'm hanging out today with my buddy, Dan Kryzanowski. You guys try saying that name in your car or on the treadmill. I had to practice that. Dan Kryzanowski. That's a good one, Dan. And Dan is a rock star in this space and in the alternative asset space. And by that, I'm talking self-storage, multifam, and some of the other alternative asset classes, and in the IRA space as well. And is an expert in that. Looking forward to digging in to that with Dan. But Dan, welcome to the show, and I'm super stoked to hang out with you.
Awesome, Tate. Great to be here. And I can tell you're from Ohio. You got my name perfectly. So congratulations.
Well, I am from Ohio, and as a matter of fact, and as many of the listeners know, I'm from Cincinnati, but we invest in Columbus. We own property up there. And so I'm back in Ohio a fair amount these days, and I'm definitely connected to my Ohio roots. And my Cincinnati Bengals just did a great postseason Super Bowl run and everything else. But actually coming to you today from Oklahoma City, of all places, where we also own some property. That's our other market aside from Columbus. And we're here dealing with some property management issues and making some changes and cleaning up some messes. So it's a good diversion to get to talk shop a little bit, Dan. So I'm stoked to do this.
Awesome. Excited. Thanks for having me.
Yeah. So Dan, you're coming to us from Austin, Texas, home of Austin FC. Have you gone to any of the soccer games yet?
I have, and there's not
nice.
a bad seat. It's absolutely amazing. And thanks to my FinTech buddies at Q2 for naming the stadium, and
nice.
My friends at Lexus for having a box. So it's great.
Oh, that's awesome. Yeah, I'm a huge soccer fan, Major League Soccer fan. I think is going to be in 20 years it's going to, they're talking about taking over baseball as the number 3 sport in the country. And I can see that happening. I really can. It's the popularity in a place like Austin. You go and you watch that on TV, and the atmosphere is electric beyond measure. It's so exciting. And go to a baseball game, you don't quite get that kind of magic. But well, Dan, so let's just kind of start square one and tell us a little bit about you and kind of your background and professionally where you came from and how you got to where you are today.
Yeah, so I grew up in Scranton, PA. So I like to joke, and this will be my only political comment. I played on the same Little League field as Biden, and then as a freshman rode with Trump Jr. So
there you go. Wow.
But my best athletic feat by one Kevin Bacon level of separation, we beat the guy who's supposedly better than Kobe Bryant in 8th grade to an undefeated state championship. So
nice.
Once again, claim to fame, dating myself a whole lot here. But
cool.
Yeah, for a lot of us, I say Gen Xers and above listening here, very standard, especially to 2008. Worked corporate, went to school, maxed out my 401k. Everything was pretty standard. Fast forward, you had this, I'd say, first wake-up call in 2008. And then for me personally, I had to think, did I want to do the commute? I was with GE Capital at the time, into New York City, or the reverse commute. I didn't picture that as a lifestyle choice that I wanted. Mm-hmm. So, with that, I feel we were about a decade ahead of everybody by moving to Austin, Texas. And from here, I've had the benefit to be doing the equivalent of crowdfunding before crowdfunding, probably being a good, X number of years learning about self-directed IRAs versus, I'd say, the average, investor, quote unquote. And that's just been part of my mission, I'd say, for about the past 10 years.
Awesome. So what do you do now? What's your what's your specialty these days, and what are you most passionate about?
Yeah, I mean, part of it, and it's this probably till the day I die, is that everybody here is aware, whether you're an aspiring investor, a current investor, you're raising money, that us as individuals in the States here, we can use our retirement dollars to invest passively in real estate.
Mm-hmm.
And this could be everything from a small check to actually owning a small building. It's
Mm-hmm.
extremely powerful. It's I think what we have to realize, and COVID, I think, really showed, is we live one lifetime. We have, one bucket of assets. I know some younger folks, and you probably have had this on some of your Tate, some of your sessions, that they basically clear out their 401k or what they inherited as early as possible because they want hard liquid cash. I still think there's a benefit if something is already in an IRA or otherwise, but I think realizing that this in aggregate is at least a $10 trillion bucket of money.
Mm-hmm.
That's generally untapped, frankly, because the education is out there. Up to about 5 years ago was an old stodgy process that has since been removed. All of this can be put in, and I feel the most common asset class, is multifamily, that folks they've used, they can figure it out. And I feel a close second is self-storage, which is becoming a natural extension of multifamily.
Yeah, it sure is. They kind of go hand in hand.
Mm-hmm.
And self-storage now at the end of an economic expansion cycle, or maybe we're not at the end, maybe we're in the middle of the new normal. I don't know, but self-storage units are in as high demand as they've ever been. People have more stuff than they've ever had, and they don't like to get rid of it. Mm-hmm. And they want to have a place to put it. And if you own a place to put people's stuff, you're going to make a lot of money, and you can make a lot of money. And so it's an exciting business model. It's one that we at Greenlight haven't delved into yet. We've done a lot of types of investing leading up to this alternative asset class investing, but as far as larger scale commercial assets go, we've stuck to apartments and multifamily, and there's a lot of reasons why, and a lot of those reasons why are the same reasons why you would want to be in self-storage, like the cash flow, the appreciation, the ability to force appreciation by increasing your NOI, your net operating income, by either increasing rents or decreasing expenses or both. And you're exponentially increasing value whenever you do that. You got tax advantages, depreciation. The list kind of goes on and on as to all the advantages of owning these assets. And as Dan is illuminating, we have the ability to, through apartment syndication, we have the ability to self-direct our retirement accounts and invest passively in these assets through apartment syndications, which is what companies like myself and Dan, do you guys syndicate?
Yeah, so who I'm associated with, I'm licensed. So there's my little disclosure statement on BV Capital. And yes, we do syndicate, and we have a variety of workforce housing, student housing. Fun fact, we were one of the original multifamily funds on Crowd Street.
Nice.
Way back when, a good 5, 6, 7 years ago. So yeah, we syndicate out. We have relationships with over 600 accredited investors. One of our partners came up through the investment advisor channel with slightly different lingo, slightly different way to underwrite, but I'd say one tip of the cap, at least as individuals, 50 advisors have dropped a check with us, and then an extension of that, whether through an advisor, broker dealer, double digits that have written checks on behalf of their clients. And no surprise, it's the underwriting. I think it's the boots on the ground. We take advantage of being here in Texas. A very strong majority of our stuff is in Texas. And as I've heard, you guys shared many times, it's on the management too. So if it's funny, a student housing deal that we have, the manager actually in the 90s was an analyst on this deal. And then he became a student housing manager. So obviously this is a really good person to have. And other times, for example, on one of our workforce housing deals, we were quote unquote kind enough to offer an office for the manager to sit with us, vis-a-vis, being X miles down the road and having a tough time getting in touch. So as I said, I think it's just kind of the little things of keeping everybody in the family. And I know some folks have done that from the GP cap stack. I just think, especially as the world has reopened via COVID, hey, if we can all be in the same office together, what a great bonus that we're all literally speaking the same language on the same property.
Mm-hmm, mm-hmm. Yeah, fantastic. So can we talk crowdfunding real quick? I know this is a little off topic, but it's on a selfish level. It's something that we have started to explore, because we're constantly deal sourcing and keeping our pipeline full ideally. And we're looking at doing about a deal a quarter right now. And so the bottleneck, well, there's not really a bottleneck, but if there was one, it would be in equity, I guess. And we always seem to source equity when we need it, but it sure would be nice to be plugged in to something like a CrowdStreet, where you can basically go pitch a deal and boom, you got what you need. Is it really, I mean, when you get, I guess there's probably a pretty long setup process and or vetting ramp up process kind of thing, but does it make things really as easy as it seem like it could?
Yes. And here's why I say, if you have good product, and I would say also, if you know the respective crowdfunding site, if you know how they like their diligence done per se, and you have that and it's slick and it's clean, it's going to help you in that discussion stage. Do they say, does your product make sense for our platform at this time?
Mm-hmm.
Let me take a pause here. There's other folks that have come, I'd say the new kids on the block, where you can just put your deal, because frankly, they're looking for deals. Now, that's fine, because A, you're probably not getting charged. It's free exposure. You're listing your deal terms. It's not just only you're listing your brand. But on the flip side, they probably have nobody really coming to their site. So was it worth it even for you to upload your docs for an hour and go through all that?
Sure.
On the flip side, I said the likes of a CrowdStreet, very established, I'd say a pretty good internal diligence sort of process here. And your brand is going to get exposure, sure, outside of the investor, coming in and having a good experience. So that said, everything comes with a cost. The cost models, they vary over time. Like any crowdfunding platform generically, there's a few things, and stepping outside of strict real estate for a moment, just an inside hack. I know it's certain platforms. So think of if you don't hit a certain number, whether it's 25 or 50K on day one, which I know for real estate should be relatively easy, but think more consumer products or startup, you're thrown to the back burner. You don't get, call it the love of their 500,000 or 1 million subscribers on top of the email list. So like anything, I would find out to see how things really work. What is their audience really? Is there a certain little hurdle that has to be hit? And this is more with, I'd say, up and coming sites. It's much like being the podcast world really well. Does it make sense to sponsor on a podcast? Okay, what are the true metrics and such?
Right.
But ultimately, the benefit for I think crowdfunding is the exposure that you are going to get. A question that you ask is, who owns the investor relationship? For sponsors, it may seem obvious that, oh, well, this would be us. Well, actually, if it came through a crowdfunding platform, I feel they have a pretty fair claim. So once again, a type of question that, like anything, I would find somebody that's been on the platform, speak with them offline. What were the 3 things that you were unaware of or that you wish you would have asked in advance? And I think the questions you bring up. That's
great advice. Listeners, write that down. Check referrals and references, and anytime you do a GTS, a Google that stuff search, anytime you do a GTS on something like a CrowdStreet, for instance, these days you're gonna have YouTube videos with people talking about the ins and the outs and the ups and the downs, and they're gonna compare something like a CrowdStreet with another source, and there's going to be articles and blog posts, and there's just a wealth of information at Google University these days, and YouTube University in particular. I think you can learn just about anything, and certainly in this world, there's a absolute wealth of stuff like this out there, quite frankly, and a lot of how-to type stuff. So okay, so zooming out a little bit, you talk about this $10 trillion in IRA money, and I mean, that's real, like that's measurable, right? Like people, we pretty much know that exists. What is that mostly in? I mean, are people mostly in stocks with that, or is it mostly in cash? Or
I would say funds, and I preface.
Mutual funds.
You're right. There's going to be a piece in straight stocks. There's going to be a piece in straight bonds. There's going to be some sitting in cash. A lot just go into funds. So let me use my personal situation. I started my career at Merrill Lynch. I had a 401k. I left Merrill. It went into Fidelity. I was at GE. I think we used Voya, one of the providers. You're in these funds. When you leave, particularly for the Fidelity Vanguard, you're probably in one of their funds. And you're probably not going to change it. Life moves on, et cetera. That in the aggregate is the 10. And then, of course, your current company, or say a 401k or IRA that cannot be touched or transferred over yet. Think of your current employer. That can be another 20 trillion. And then for my self-employed friends, including the 1.3 million realtors out there, something called the solo 401k, also known as an individual 401k. This is actually, all else equal, the better of the two products, because you can contribute over $50,000 a year. And if you're a married couple without W-2 employees, you're looking at six figures that you can lower your AGI annually if you have a pretty good year. So I share all that because with all that said, at least from the self-directed IRA, you're maybe looking at 200 billion. A very small percent that is an SDI raise, because most folks, they set it and forget it. They keep it in a fund. And the fact that equity markets, outside of the obvious, COVID dip real quick, nothing's really gone on in 15 years. I mean, things are sitting pretty that even if, you and I, we showed our cap tables to folks like, hey guys, we're making double digits. Most folks in a, equity heavy fund can probably show pretty much the same over 10 years. So I think the music is starting to slow down in equities, and the called scratch of the record per se. So I thought this was going to happen 2 years ago during COVID, but I think with the excess money supply that we have now in the States, I do think enough people are going to pull out to say, boy, I really want to be in a tangible asset. I don't just want to blindly be in the stock market or some fund, or, well, I've been 50 stock, 50 bonds. Bonds are making zero. Inflation is 5, 6, 7. So this is becoming more dinner table, more front page sort of conversation that I think you are going to see some significant dollar shift into real estate.
Yeah. More significant dollars, shifting into real estate, because we've already got, especially in the commercial real estate world, a ton of liquidity in the space, as you know, and as we know, and this is just going to add to it. But I feel like there's almost a moral obligation here on my part, and I think you've taken it on too, Dan, to let people know that this option is available. You drive down the street and you see these apartments, and they're big, and you see a 200 unit apartment building, 250 unit apartment building, and it takes up a city block in Oklahoma or Columbus, and it's building after building after building after pool after leasing office. And it's like, how in the heck does somebody buy one of those? Like, up until 5 years ago, I didn't have my head around that I could possibly buy one of those or be part of buying one of those, which is ultimately what you end up doing. And apartment syndications doing these 506B, 506C projects where you can invest passively in an apartment syndication, which is basically an assemblage of funds between multiple investors into an entity that owns part of this apartment asset. It's really, really powerful. And in most syndication arrangements, the limited partners get treated very, very well, and very favorably by the terms of the debt, or not the debt, but in the returns. Like the structure of the returns is always usually very favorable to the limited partners, the passive investors. And it's really, we've talked about it in the past being really the creme de la creme position in the whole project. You get paid first, you get paid the most, and you have the least to do. So,
That's Chevy.
yeah. So, I think getting that, there's 200 billion right now in SDIRAs, right? Self-directed. Yeah. SDIRAs. But there's 10 trillion in IRAs. So our mission is to educate and let people know that these opportunities are there and like really how to do them. So like, what is a good next step for somebody that's, let's say, sitting there listening, has an IRA in place? What do they need to do to, let's say they've got a few $100,000 in an IRA and they want to put it to work and try to make, a 10% average annual return in an apartment syndication. What are the steps, Dan?
Sure. So I'm most intimate with Rocket Dollar, and why I want to share, because, and I say this in a very specific order, Rocket Dollar offers checkbook control self-directed accounts versus a custodial SDIRA. Why do I share that? Is because I feel us as investors, we should have access to our money 24/7 and the right to invest in what we want, when we want, based off of our diligence, vis-a-vis having to fill out what feels like some, not just us, but also the sponsor, some random third party. Secondly, technology has caught up. It should be a flat price. I think anybody that charges an asset under management model, it's disingenuous. So for example, if you invest 100K, God forbid you made a good investment and your balance goes up to 200, well, why should you pay more? You're the one that did all the work, not the third party. Yes, the third party still receives a certain fee to keep the lights on, but I preface with that. So a great resource is this is an award-winning knowledge base, rocketdollar.com/learn. It's, as I said, from a legal perspective, as what can be shared about this legally is shared. I feel it's in layman's term, laywoman's, layperson's terms. And the sign-up process is simple. It's for those that have been on, Betterment, Wealthfront, anything else that you feel is a 21st century FinTech model. It's a 5-minute sign-up. Everything is e-friendly, click away, driver's license, credit card, and then in the background, you receive a checking account. So the best analogy I can is much like your health savings account, you have a bank or credit union that holds this, and then you know what not to do per se. Your kid breaks his arm, oops, you got to go to the hospital. You want to buy a new car. Well, sorry, you can't do that in your HSA. Same deal here in the self-directed world, no life insurance, no collectibles. And the big thing I want to make clear is not yourself or your linear family. So what does that mean? Your primary residence, a beach house, you or your parents cannot stay at it, your kid's startup, your spouse's company, all of that is out of play. Cannabis also, I'd argue, is out of play. Everything else is in play. A friend, as you talk about the 200 units in Tulsa, you can put 50,000 in that investment. A loan to a female entrepreneur, a startup, something international. One of my, and sorry if this is one of our final, hit round sort of questions, but the best story I heard is a pilot out there said, hey, I've traveled the world, I've seen everything. I want to live in the Caymans. Great. And I have $1 million and these condos are going for $250 a pop. Let me buy the next 4 condos down. Have somebody manage it, but then I can literally kind of walk by my properties every day. I just thought it was a really cool real life story of folks that you're owning physical, tangible asset instead of being in, the year 2030 or 2050 target date fund. Yeah.
It's a real estate is so exciting. Anybody that's listening to this doesn't need to be preached to on this, right? We've all drank the Kool-Aid, I think, in terms of we're all believers and we're all true believers in the power of real estate to both build cash flow for financial independence and also build your balance sheet for wealth generation. And the ability to do both of those things at the same time and save immensely on taxes is such a wonderful thing. And it's the reason why I do this podcast, is because I want as many people to know about all of this as possible and to know about these options. And this is a great example of something that all of us should know about. I'll be real. I don't have an IRA because I haven't worked in the corporate world since I was about 20 years old. And I've been in one entrepreneurial venture after another. And so, which is not an excuse, by the way, to not have a retirement account, but it basically have just ended up, leveraging what I have had to do to get all the deals done that we've done. And we're in such a rapid growth phase that I'm kind of all in on that right now. But Tate, I know there's, yeah.
If I may, because I've talked to a lot of, I'm in Austin, Texas here, a good entrepreneurial town.
Yeah.
What you'll see is over time, let's say you sit on a board of directors. I just want to preface, because, all right, the SDIRA, you're not going to put in big numbers into that. But once again, much like our realtor friends, this is 1099 income that you can right off the bat, let's say, or you and your spouse have an LLC where you're both on the board, or a small business, just like your W-2 friends that do the 19.5. Mm-hmm. Right off the bat, the first $39,000 can go into a solo 401k, and then 20% of your net earnings. So a simple example, you make $100K on the board or a side consulting project yourself as an individual. Right off the bat, you're looking at $39,500 that you can set aside into a tax deferred account. So I share that with folks, and I totally hear you loud and clear with the benefit of taking every dollar, levering it up. But there's times when a certain strategy could play in. And I think naturally as we progress in life, just to be aware of that also as folks, I mean, especially that are as a consultant now or sitting on a board, really take advantage of those dollars that come in.
Yeah, no, and in no way am I making an argument that I'm doing it the right way right now, because I do believe in diversifying. And it's an interesting thing. I had a good buddy on the show, and we were talking about his startup process and getting from the literally sitting in front of a laptop, starting a website, to selling his company for $78 million, and everything that it took in between. Actually, I think it was $780 million what he sold it for. And all the things that it took to get from point A to point B. And it's the exact opposite of being diversified during that period of time, right? Because you are 100% all in on your business. And quite frankly, that's where we are right now. And that said, like you said, I have to live. I do have an income. And so for me to not be taking advantage of this solo IRA, which to me is one of the biggest takeaways of this episode so far, is the solo IRA concept seems really, really exciting.
Yeah, to clarify, there's so much terminology. Probably the cleanest is the solo 401k.
Solo 401k. Excuse me. Thank you.
All right. The individual 401k. There's somebody that has an acronym that starts with an E. It's the exact same thing.
Yeah.
And I just share because the benefits of a 401k versus an IRA are a little bit different. And I just refer back to rocketdollar.com/learn. Such a great resource to be aware.
Do you have to be an accredited investor with Rocket Dollar?
No. So just to be clear, let's share what Rocket Dollar, and I'll give props to Alto, another new kid on the block, on the custodial side, Quest, who's here in town, Texas with me. So there's a lot of folks out there, and like anything, I suggest for folks to shop around. But to be clear, any self-directed provider, it's not a crowdfunding site. It should not be listing deals. It should not be taking fees. It should not be telling you what to invest in any way, shape, or form. It's giving you the tool so you can do that in a legal way.
Mm-hmm. Mm-hmm. Okay, got it. I'm really excited to dig into Rocket Dollar. That's an awesome takeaway. Cool. So, in the world of equity and capital raising, just to switch gears completely here, what do you see in the way of technology that's moving forward? And you have an inside view on this lane. And what do you see as exciting stuff on the horizon with raising capital?
Yeah, I think I'm actually a very long story short. I learned of something called Unicoin. Sounds like unicorn. It's a coin, no doubt. Everybody's familiar with Shark Tank, I'm sure here. There's another show on Amazon very similar. and these will be later stage companies, not as much real estate, I'd say, but I share because I think you are going to see this in real estate. So let me share the concept is that instead of, buying with Bitcoin, that is becoming a little more familiar, or at least the headlines becoming familiar. The likes of a unicoin, and I'll preface there's a lowercase unicoin that's been around. So look for the big unicoin that's doing the full paid edge in the Wall Street Journal and such. Anyways, in short, you're basically buying your dollars become a unicoin. Your unicoin earns potential. It's backed by real estate, not just having a coin. You can earn dividends, albeit I'd say earlier stage, a little bit different than the real estate model. But my point here is that think of an asset-backed coin. And then once again, when you pull stuff out, you're getting real dollars again. So it's almost like this dollar goes into this magical coin world and then comes back out here. In real estate, and there's been things for a few years, and I'm a little hesitant to mention a particular brand because I think the spirit is what the holy grail is when your dollars become a certain coin on the blockchain and you have there's a marketplace, much like you see in the stock market or on a NASDAQ market maker. I know some folks have pushed for different parts, or that's been the thesis. It's much easier said than done. I'll put it that way. But I think folks have been making more progress to a two-sided marketplace, much like you'd have with a stock, but based on your holding in a real estate. So I think that's something, I don't want to say how sooner than later, but in this decade, it's going to become more common. And then like anything, I feel it's going to be very sort of app friendly. So part of this is for my sponsors on the call, it's how is your deal structured? If, even one little piece of money moves, does that mean you have to revalue for everybody else? What is the legal compliance headache? I just think there's a lot of opportunity, and the industry wants folks to be involved, much like, a video game per se, or frankly, how the stock market has become. I think in the private world, that's collectively that we just want more folks to have more access and the ability to have daily liquidity for a small subset of investors, but it might grow, or on certain asset classes is becoming more of a strong demand. So let's see how that all plays out. And then, finally, will it be 100% fully legal? I don't say fully legal, but not in the gray area for certain platforms. Maybe, maybe not. But, once again, Uber was definitely not for a while, and it's commonplace now.
Yeah. Again, technology just forcing the change, and blockchain is here to stay. I don't think there's any doubt about that at this point. Although every now and then I run into somebody that seems to think it's not. It's just beyond me. It's just a flash in the pan, it's just like snake oil kind of thing. Like, yeah.
I mean, crypto, frankly, could go away, but blockchain won't. And most folks, I think, generically, and I'm guilty up until a year ago, I would say crypto meaning kind of all of that stuff. It's very different. Blockchain and crypto and coin. Two very different things. So you're right. The blockchain technology, it's ingrained, it's here to stay.
Yeah. And let me just make sure I heard you right. You think crypto as a like a legit value, like right now, I don't know, is it about 2 trillion in valuation or something like that? In Bitcoin anyway. You think that could go away?
Not as much go away. It could, without much of an effect on, I think, normal business practices, society. So first of all, just a great book, Ray Dalio's Changing World Order. I highly recommend it, just for all of us as adults, or naturally interested folks. It's a great read. And but with that, even the U.S. dollar, it's not backed by gold. It's not backed. It's backed. A lot of currencies are backed by a promise. So if you're starting to see in some developing countries, Bitcoin is becoming more common. Some folks might, for political reasons, otherwise other countries might not want to peg to the US dollar. So I think there could be a place towards it, but at the end of the day, it's not backed by anything. I heard, up to 20% of Bitcoin's in limbo. I don't know who verified that or how you would verify exactly how many, kind of the coincidence of the dollar under the mattress that got burned. I don't think it's that high, but the real question is, is this a hobbyist thing, much like a baseball card, which I'd always, Bitcoin, I heard a great thing last year at a family office show that if every millionaire wanted a Bitcoin, only 1 out of 3 can have them. So for that alone, I think there's a lot of potential upside. And just frankly, maybe the ease of transacting, if Bitcoin or other coins can be done in real time, particularly for larger dollar transactions versus banking, where you still have the T+1, T+2 clearing. I mean, that's kind of ridiculous these days. So yeah, I think some smaller coins will also tie into the blockchain in a positive way. And maybe this, Bitcoin, I think, is a global phenomenon. Some of the other ones I think might get more towards a region or more towards, frankly, an industry. And people are going to ask questions: what is this backed by? How's it collateralized? Who is it by? And you can argue those same questions are coming now to governments. And a final point, without tangenting, is I think there's a personal benefit for individual freedom to have fiat versus something electronic that folks can track for multiple reasons. So, as I said, yeah, it could go away. On the flip side, it could become mandatory here, in certain parts of the world. So, but the world can live without it. I said blockchain is just a technology, call it similar to, I don't want to say Wi-Fi, but email, what people thought of 30 years ago, and it's obviously really ingrained now. So blockchain is there. It's behind the scenes, not as common as Wi-Fi or email, but it's already into a whole lot of processes and everything else. I don't think that's going on.
Yeah, I don't think so either. It's here to stay in a lot of different applications for sure. Fascinating stuff. You guys, you smart guys, are fascinating for me to talk to. I love having this show and having you smart guys on because you know a lot more than me. And it's fascinating to me to get your perspective. So in the multifamily space, what are you guys doing at this point in the investing space? What kind of deals you going after, and what are you most excited about there?
Sure. So, I mean, with BV Capital, where I'm licensed under, the benefit of being a broker dealer is it's relatively easier for us to team with best of breed operators in other asset classes. So, of course, being a Texas shop, we teamed up with the gentleman from Archway, ex-Trammell Crow guys. They've been in triple net industrial. The world's moving to Texas. The stuff is here per se. People are familiar with last mile, industrial, e-commerce, et cetera. It's a pretty strong asset class. So in the spirit of a cash bond replacement, we have a portfolio that kicks out a monthly distribution, very tax advantage fee, return of capital, 7 pref, 15 IRR for the next 4 years. Separately, we, I referenced some workforce housing from student housing. These will be relatively smaller sort of plays, frankly, as a thank you to our investor base that will share these. A lot of these, are the 20 plus IRR over 1 to 3 year period. And then finally, what I feel makes, BV unique, when we find a plot of land at a fair price, much easier said than done in Texas, we'll chop it up to a stage 1 and stage 2. And for a stage 1, which we call the land side versus a development, we may pay upwards of 20%. And why do we do that? Once again, we value the investor relationship, not to cliche it, but to really share some of the gains of the deal up front in the stage 1 by paying up to 20%. But there's also other advantages for rolling the principal and interest into a stage 2. And once again, we could be Sunbelt with some of our mandates, but we have the benefit of being in Texas, and some of it's just dumb luck, being boots on the ground here for so many years. So that's the main focus. Myself personally, I've been around self-storage for over a decade. I love to invest passively, once again, with my solo 401k, with my self-directed IRA into storage. If I may for a moment, I think storage is a natural extension of multifamily. And at least how I see it in Austin and other hot markets. I mean, a few years ago, you couldn't even say 3-bedroom. Nobody would show up. You had to call it a 2-bedroom and a den. Now, good luck finding a 3-bedroom. So let's say you have another child, or you have to work from home. What do you do? Well, we joke around stuff. I'm sure for some of our parents, they called it crap, affectionately in the Northeast. And sure, there's some of that, but I do feel what's going into storage is not just stuff that you want, but stuff that you need. So it goes from your stuff to trading off skis for snowboard, to the point of feeling, if you don't want to feel like you're hoarding, you're putting in your kids' winter clothes, your tax documents, frankly, really important stuff. Why is that? Well, you can't find that extra bedroom. And if you did, you're probably paying $1,000 extra a month, vis-a-vis maybe finding a storage facility for $100.
Yeah.
The math works out pretty well. And, in storage, we talk about the 4Ds: debt, divorce, dislocation. For example, the final one, the new one, is decluttering. And one thing I think from the for how much time folks we will spend in the house, or we perceive we're going to spend in the house post-COVID, there's a conscious effort to declutter. But once again, it's some of the stuff you want, but also some of the stuff you need. Storage becomes this natural extension. And what's really unique, many of us have touched it, especially later in life, for grandma passing, death, divorce, etc. And then younger folks say, cool, well, I don't want to buy storage for myself. When I was at college, I had me and my 4 buddies, but the amazing thing is you've touched the product before. You know how it works. It's becoming more tech friendly, the ability to go in with your app, etc. So I think with all that, and then also I feel a fair number of multifamilies, even if it's not air conditioned, have at least X amount of storage. So when you come in to sign your multifamily lease, you are given the option for storage, or said, hey, there may be a storage facility or storage component on site here. A lot of times it's not. Or for our example here today with the 200 unit, maybe there's only 8 to 10 of non-climate controlled storage in your Tulsa site. Obviously, there's probably a fair amount of storage, particularly in a larger city or smaller, that you can. So I think it's just becoming part of where folks live, where they keep their stuff. How folks operate. Folks with the business, t-shirts, etc. You're probably going to use that for your inventory, not your house, for multiple reasons. So it's playing out in spades.
Yeah. So there you go, listeners. There's your argument for self-storage and the strength of that particular market. And it is hot. And that said, it's one of those things you need to do your homework on when you're looking at these deals. You can be in the hottest market in the world, and it can be oversaturated, right, with storage facilities, and that can be true with any asset. And it's less and less true when you have such rapidly expanding economics in most of these markets, like we do right now. When the rubber meets the road, so often it comes down to just good management, right? Like being really good boots on the ground, or being really good asset managers of your property managers, and making that business model happen and getting the returns that you need to get. But yeah, that's exciting. And I like how you contextualize it as being a natural extension of the multifamily world. It really is. Makes a lot of sense. So Dan, do you offer coaching, or if people want to learn more about opportunities, especially in the solo 401k space, SDIRA? I don't have such a problem with that. I know there's 5 letters there. I want to just keep it to 4, but the SDIRA space. How do people want to reach out and get in touch with you?
Yeah, I mean, LinkedIn is the best, and say you heard Dan and Tate talking today, and that's always great. As I said, just for self-education, rocketdollar.com/learn. Dan at Rocket Dollar, but I get so many emails. That's why I preface LinkedIn, because I do take my LinkedIn inbox seriously. And then finally, I joke, if you can spell it, you can get it. D. Kryzanowski, 12 letters total. That will get you, a decent chunk of change off a Rocket Dollar account, should you feel inclined. And likewise, anybody raising money too, feel free to reach out to me or other influencers on the space. I can connect you with the right folks at Rocket Dollar.
That's great. So listeners, Dan, I'm going to spell it one time here for you. So it's Dan Kryzanowski. So Kryzanowski. And so if you didn't get it that time, hit that 15-second back button on your podcast app. But that's it. So it's D. Kryzanowski is the best way to get a code. That's a discount code for Rocket Dollar?
Where it says referral code, just enter D. Kryzanowski. That'll get you.
Okay, perfect. Okay, well, there you go, listeners. You got the hows and the whys, and the whats, and all and even the who's. Like, we've got Dan himself here, and he's here to help any way he can, and I'm always here to help as well. Although I will say this is not one of my lanes of expertise. It's one of those that I need to learn as much as I can about, as fast as I can, as we grow. And I need to be setting up my IRA accounts and taking advantage of what they have to offer. So Dan, I really appreciate you hanging out and enlightening us and showing us the way here.
Awesome, brother. Always a pleasure.
Yeah, likewise. So listeners, thank you for listening to another episode of The Apartment Guys. Hope you got a lot out of this one. If you did, as always, please leave a rating and review. An honest rating and review is all I ask. And I love it when you do that. You can do that on the Apple Podcast app, or I believe you can do that on the Spotify app. I'm not 100% sure about that. But anyway, I really appreciate when you do that. And as always, go to investwithgreenlight.com to reach me and set up an appointment with myself to discuss any needs you might have in your investing world. No strings attached on my end. And that's just something I love to do for listeners. So please take advantage of that if you feel so led. Investwithgreenlight.com. And otherwise, we will check you on the next episode. Take care, everybody. Thanks again, Dan.
Thanks for listening to The Apartment Guys with Tate Siemer. Tate and friends are grateful to have you as a loyal listener. If you like what you've heard, please subscribe, rate, review, and share with friends on your Apple Podcasts, Google Play, Spotify, or any other podcast platform. Also, check out Tate's YouTube channel for videos of many of these episodes and more. Until next time, take massive action steps and rock on.